Hello, good morning, good afternoon, and good evening, everyone. I see a lot of fellows here, uh, mentors as well, people from all around the world. I want to ask you to please write in the chat where you're speaking from, what class did you join us, and it's an immense pleasure to have everybody here today, and also to have Dan and Libby from the University Impact Fund. This will be a special session for us. Please take all the benefit of having these two amazing impact investors here with us. Ask all the questions that you want to know that you ever wanted to ask an impact investor. They are here for this. And thank you again, Dan and Libby, on behalf of the entire Yunus and Youth team. We are incredibly happy to have you here. The idea is that they will speak about University Impact Fund, about how they invest in social businesses all around the world. You can leave your questions in the chat, or after they're finished, you can just open your microphone and ask your questions directly to them. So hope everybody has a great session. And then the floor is yours. Thank you.
Awesome. Well, Marcella, thank you so much. So my name is Dan Blake, and I'm the managing director at University Impact, and I'm joined here by Libby Malone, who's one of our senior associates. My background started somewhat similar to all of you. I was a social entrepreneur. So I was attending college at Brigham Young University, and actually decided to leave my studies to start my first company. And it was a company that recycled food waste into lawn and garden products, so soils and plant foods. So I grew that to be one of the largest food waste recycling companies in the United States, as well as one of the largest organic brands of lawn and garden products in the United States. And then that company was acquired by a Fortune 500 company. And then I've since worked in various other social enterprises. And so the idea of social entrepreneurship and working with social entrepreneurs, is near and dear to my heart. Super excited to be here with all of you. And Libby, do you want to quickly introduce yourself?
Absolutely. So, hi, I'm Libby Malone. I'm a senior associate here at UI, and I am still a student. That part of the mission of University Impact is to train the future leaders of social entrepreneurship and impact investing. So I am a senior at Brigham Young University studying supply chain and operations. And my background is primarily in operations consulting as well as corporate social responsibility.
Awesome. Thanks so much, Libby. So like Libby alluded to, University Impact is a little bit different than most other impact funds in that all of the investment associates are university students, undergrad and graduate students. And they come from universities all over the world, universities like Oxford, Wharton, the University of Cape Town. We have a new cohort starting this coming January. And we've had students apply from over 19 different universities in half a dozen different countries. And so if you look at the mission of University Impact, our goal is to be an impact investing vehicle focused on solving more of the world's social and environmental problems. As we look at the world of social entrepreneurship and just compare it to entrepreneurship in general, there's not as much capital going towards social entrepreneurs. And so while we won't be the solution, we hope to be a part of the solution in getting more money to social entrepreneurs. And then the second aspect, when we look at the overall ecosystem, there's a lack of capital. I also think there's a lack of talent. And so that's why we focus on university students. And so we also want to give all of the students that go through our program this really hands-on immersive learning experience to help train up the next generation of social impact leaders. And then the third, within impact, I think it's incredibly important that we are just as deliberate about measuring our impact as we are about measuring our profitability. And so if if we're going out and we're telling people that we're solving these really difficult social problems, we should have the data to back it up. And so that's the third goal, is to be the standard on how to measure impact, both from an impact investing and philanthropy standpoint. And so just a little bit on our management team. Our leadership has a wide variety of backgrounds, coming from some large family foundations, educational institutions, family offices, traditional investing, emerging market investors. We think it's really important, as we make decisions, that we have a wide perspective, so that we can make the best decisions possible.
Thanks, Dan. So for the next few minutes, we're going to walk through our investment process, as well as our criteria for some of the different kinds of investments that University Impact makes. So our investment process is pretty similar to what you'll see in a lot of funds, so it starts with a deal sourcing process, and this is where we make contact with the social entrepreneur. A lot of the times it's through a referral or through a social entrepreneurship contest or something like that, but sometimes we'll do cold outreach to social entrepreneurs who are interesting to us. And so we will have a deal screen call with that entrepreneur, and we'll get some preliminary information about the business model, about the social problem that you're solving. And this is our entire due diligence process is led by our student associates. So you'll be interacting with one of our student associates from the deal sourcing stage all the way through the due diligence process. So after the deal screen process, we'll have the other associates at UI kind of vet the deal screen. And if it passes that process, then we'll move on to due diligence. And due diligence takes anywhere from 4 to 9 weeks, just depending on the circumstances. And during the due diligence process, it's if you've interacted with any other investors before, it'll be fairly similar. We're going to be in constant contact, getting information about you, doing financial analysis, and writing a thorough memo on your company. And then it'll be taken to a vote with all the managing directors and student associates at UI. And if there is a majority approval, then your company will move on to the investment committee. We have investment committee meetings once a month. And the investment committee will ask questions of the associates, and if they have questions that can be resolved in that meeting, then we'll get back to you and continue the due diligence process. But if not, then the investment committee will vote to approve or deny the investment. And then if the investment is approved, we'll move on to the funding process, which involves writing term sheets, determining the exact terms of a loan, etc. And then we'll move on to the portfolio management stage once you have been invested in it and are one of our portfolio companies. And this can be anything from continuing to work with you to build out your impact measurement plan, tracking your financials, anything like that. And yeah, that's that on the investment process. If you can move to the next.
Really quick, Libby. So while this process is specific to University Impact, most other venture funds will have a very similar process. And the timing might differ, but one important thing as you start to interact with investors is to ask them what their specific investment process looks like. What are the individual steps? How long does each step take? And what you'll see when you add all this up, this actually takes a fair amount of time. So while no individual steps might take a long period of time, when you add them all together, it really does add up. And having been an entrepreneur, it can be really frustrating when you feel like this process is just going on and on and on. But when you understand the process that they're going through, and you understand that the timeline beforehand, it makes it, you know, that much easier for you to plan ahead, it makes it easier on them. And like Libby mentioned, with our investment committee, so what is that? This fifth step, that's a really important step for us, but it does only happen once a month. And so if we get the timing off, all of a sudden you're delayed an entire additional month. And so with some of these things, it's important to ask the venture fund, when is your investment committee? You know, for us, it's the third Wednesday of the month, and that just happens every single month. And so it's really important that you get clarification and transparency on what this process looks like.
Thanks for that clarification, Dan. And yeah, I do tend to get a little bit caught up in the specifics of university impact, but most of what we're saying here is going to apply to many of the investors that you interact with. So UI has a number of investment vehicles. We actually do debt, equity, and philanthropic investments. So when we do a debt investment, there are 3 different kinds of loans: working capital loans, equipment purchase loans, and debt refinancing. And we'll go a little bit into the criteria for a debt investment later on. For equity investments, most of our equity investments are going to be in US or Europe markets, just because of the higher probability of a profitable exit. A lot of developing markets don't have as much infrastructure in, you know, their capital markets, or there aren't larger firms that can acquire them. So it's less common, but not impossible, that we'll do an equity investment in an emerging market. And our check size, and this applies to all 3 kinds of investment vehicles, is typically $50,000 to $500,000. And that's because university impact focuses on that pioneer gap between the very early stages of a venture, where you're getting most of your funding from angels or competitions, friends and family, and that later on series ABC, where you're attracting potentially larger investors. We're trying to fill that gap in between, called the pioneer gap. So that check size applies to all of our investments. And then philanthropy, we have we provide grants mostly to nonprofits, but occasionally to for-profit ventures as well, depending on the business model. And sometimes we will do project-based grants. Sometimes we'll do unrestricted grants if it's determined that that's best for your intervention. And then recoverable grants, kind of similar to debt.
And again, if I can chime in really quick, Libby, this is another point that makes University Impact pretty unique. The fact that we will do both debt, equity, and philanthropy. Most venture funds will only do one. And so again, as you're talking to venture funds, you should ask them, you know, how they invest. Do they do debt? Do they do equity? Do they do philanthropy? And so, because the reason that we do all 3 is, given that we invest around the world at an early stage, it really isn't one size fits all. Different companies have different needs. So we've done this to give us the flexibility to be able to invest in as many people as possible. But most venture funds don't have this structure. And so really early on, you want to make sure that you're a fit.
Thanks, Dan.
So with the debt criteria, so we have this link. I'll send these slides to Marcella, and she can send them out to everyone. And so I won't spend too much time on this. We have a really detailed PDF that goes through all of the criteria, but high level, we're looking at 1 year of revenue history. The fact that you have positive cash flow. We're looking for some sort of collateral, and then some sort of history showing that you make your payments on time. So, I mean, with debt, it's all about, can you afford the debt, and are you going to pay the debt back on time? So equity is a little bit different. So with equity, it's not about the short-term repayment immediately, but about the overall opportunity, and is there going to be a large financial exit at some point in the future? And so what we're looking at is the ability to show a pain point in the market. Is this a big market? Is this a big problem that we think people are going to, willing to pay lots of money to solve? And then do you have a working product or technology? And so while we are an early stage investor, we really don't fund ideas. We want to be kind of one step after the idea stage of having, you know, a working prototype. And then we also go, so if there is a working prototype, we want to make sure that it actually solves the problem that we want it to solve. And so we want to see some degree of traction. The easiest way to show this is obviously revenue, but you could have beta users, you could have a wait list. There are other ways of showing that yes, you have traction and that your product or service does actually solve this pain point that we talked about in this initial point. And then we also want to understand, what is your roadmap? What's your roadmap for your product or technology? How are you going to build that out? What new additional features are you going to have? How do those continue to help solve the problem? And then what's your hiring roadmap? What does the team need to look like to execute on all of that? And what's interesting for this is that roadmap then turns into a series of milestones. This, you know, milestone A, milestone B, milestone C, and we can start to assign a price tag on how much is it going to cost to accomplish that milestone. That then serves as really the basis of our conversations of how much money are you raising, when do you need it, and what are you going to use it for? And then this last point, which is incredibly important, especially with equity deals, this is a long-term partnership where, you know, we're planning on staying involved for the next 7 to 10 years. And so we want to make sure that we have a lot of confidence in the management team. And so this last one with philanthropy, very similar. We want to make sure it's very similar to equity. We want to make sure that you're solving a big problem in a big market, that you have a working solution, some degree of traction. Same thing with the milestones and strong management. And so a lot of people think this is kind of interesting, that our equity and philanthropy criteria are the same and debt's very different. But if you look at the role that the capital is playing, debt gets paid back really quickly. And so that the criteria is, you know, much more short term, where philanthropy, we're saying this is a long-term investment. With equity, this is a long-term investment. And so we definitely take a much bigger picture approach.
All right, so our impact criteria, this is a separate slide because it's going to be the same regardless of the type of investment. It is especially important for a grant, for a philanthropic investment, but because we're an impact investing fund, it's going to be important for every single kind of investment. And so social impact criteria is something that, unlike a lot of these other slides, is not going to be uniform across different funds that you interact with. There isn't really an accepted standard for how to measure and do impact in impact investing or social entrepreneurship. So you might encounter some funds who will have criteria along the lines of, social impact, we know it when we see it, or you might have some funds that have very, very rigorous statistical requirements for the kinds of data that you have to collect. But from a university impact standpoint, we don't have a specific area of social impact that we focus on because our investment thesis is mainly focused on the pioneer gap, like I mentioned before. But you need to be able to map your intervention to one of the United Nations Sustainable Development Goals. We use these as our standard for social impact. Also very important is the theory of change. And if you're not familiar with the theory of change, this is how you describe the social problem that you are trying to solve and how your intervention is solving the negative consequences of that problem. So we want to see a well thought out theory of change. We want to see that you really understand the social problem that you're trying to solve and aren't just stuck on your solution as the optimal solution to the problem. And then tied to the theory of change, we want to see that you are measuring the outcomes of your intervention, that being not just what you as an organization are doing, not just, oh, we distributed this many nets, we hired this many people, we have this many people in our training programs, but how is your intervention actually affecting the negative consequences of the problem? And this is something that can be pretty difficult for an early stage venture, of course, because you may not have a long enough history to have very robust data collection, but we want to see that you at least have a strong system in place for measuring those outcomes. Gender lens, we want to know that you have considered the problem from multiple points of view, especially through a gender lens. How is your intervention affecting the most vulnerable in the community, or those who need to be empowered the most? And then Kevin Starr's 4 questions. If you're not familiar with Kevin Starr's 4 questions, those are, oh my goodness, I just blanked.
It's a good exercise for everyone to Google search Kevin Starr. There's some great videos there. And so we'll just assume that Libby did this on purpose to give all of you a homework assignment.
Yes, thank you very much, Dan, for salvaging that moment. So Kevin Starr's 4 questions basically are surrounding your intervention and how it influences the community that you are in, whether your intervention is appropriate for the context that it's in. So those are our social impact criteria. And like I said, it's not going to be uniform across every fund. So I would definitely early in the process, reach out to your point of contact and ask them what their impact criteria are, and make sure that you're a good fit there.
Awesome. So we have one question. If we go back to equity versus debt. So debt, it should be pretty straightforward with how the investor gets their money back. They give you a large lump sum of money, and then on a monthly or quarterly or annual basis, you're paying off some portion of that. So the question is the repayment of equity and how that works. And so generally, when people make an equity investment, they're making 2 assumptions. One is you're either going to get acquired or you're going to go public. And those are really the only 2 ways that investors think they'll ever get their money back. Some people talk about paying dividends and buying investors out, and you can talk through all that stuff. The practicalities of that is most of the time that just does not happen. And so if an investor is going to make an equity investment, there's some underlying assumption that they think, yes, you could be acquired, or 2, you could go public. And so this question talks about how important it is to reinvest your profits back into the business so you can continue to scale. And most investors are going to agree with you, and they're going to say, yes, we want you to reinvest all of those profits. We don't want you to take any of the money out, because we're only going to get our money back if you get large enough to be acquired or to go public. And so there should be strong alignment between the entrepreneur and the investor in reinvesting all the profits so that you continue to grow, you continue to get larger. But it is important to understand that they are expecting you at some point to sell your company. And it's in that single transaction that they get their money back. So the last thing that we wanted to talk about before we just open it up to whatever additional questions you all have is, how do you prepare? And so these are some generic tips that I have, having been a former entrepreneur and now working as an investor. So not necessarily specific to University Impact, but just as you're preparing to ask money from anyone. So the first one is do research on the venture fund or on the foundation. Everyone's a little bit different. They focus on different things. They have a different process. And so you should be really familiar with who you're talking to. You should read everything on their website. You should read all of their press releases. You should know the backgrounds of the different investors, what boards they sit on. And that helps you put together a picture of who you're talking to. And then the other thing that you should do, in addition to that online research, is I would look at their portfolio of all the companies that they've talked to. And most funds make this really easy, and they have a tab on their website of all their portfolio companies. And you can see all their logos, and you can go to their websites. You should find a couple that are somewhat related to what you're doing. And you should reach out to the entrepreneurs. And you introduce yourself as another entrepreneur, and not everyone, but most people will respond to you. And then you should ask them, what was the process like at this specific fund? Do you like working with them? What were the different steps? How long did it take? And then I wouldn't say I need to go raise money right now, but I would say I'm thinking about raising money. Do you think this group would be a good fit? And what advice do you have for me to get ready for their specific process? And fellow entrepreneurs are going to be the single best resource that you have for preparing to pitch those individuals. And then you should always ask for advice before you ask for money. So I'd ask the fellow entrepreneurs for advice. And what will happen is they'll start to coach you, and they'll say, I made this mistake. This group really likes this other aspect. Now that I understand your business, I would really focus on this other thing. And all of a sudden, they have a vested interest in you. They're spending time with you. They want to see you be successful. And instead of you having to reach out cold to the venture fund, this entrepreneur who's, they've already taken money, they have a trusted relationship with the venture fund, they can now make an introduction. And they can say, I've worked with this individual for the last couple of months. I think this is really interesting. Based off of everything that I know about your process and the process that we went through, I think this is a really good fit. And all of a sudden, you're going to go from being at the back of the line to the front of the line based off of that recommendation. The hard thing with this is fundraising is really about building relationships. The single biggest frustration that I have when I talk to an entrepreneur, I'll call an entrepreneur and I'll say, I think what you're doing is really cool. I want to see if I can fund your business. And they say, I'm not raising money right now. Let's talk in 6 months. And I'll say, well, that's totally ridiculous, because what I actually want to do is I want to get to know you. And it's going to take some amount of time to build an actual relationship with you. So when you call me back in 6 months and you say, I need to raise money in a month, I'm going to say, well, that's too bad. I have no idea who you are. We don't have a relationship. And realistically, we're not going to build a relationship over the course of a month. Start talking to me a year in advance. Talk to me when you're not asking me for anything. No one likes it when people only call and say, I need money, I need money, I need money. But people love it when you call and they say, I just want to give you an update on my business. This is how things are going. This is a really exciting win, and I want to share that with you. And so as soon as you decide that you want to raise money, as the CEO, you are always raising money. You should take every phone call, regardless if you're raising money now or in 3 years from now, because it's all about building those relationships, and you will only get money if you have a relationship prior to when you need money. And that's the single biggest mistake that entrepreneurs make, is they say fundraising is about getting money, when no, that's not what it's about. Fundraising is about building relationships. And so that goes to this last point. People are more interested in giving you money when you don't need it. So you need to plan ahead. As soon as you need money, regardless of how great your business is, no one will give you, not no one, but very few people will give you money. If you don't need money, almost everyone will be willing to write you a check. It's totally counterintuitive. It's super frustrating as an entrepreneur, but that's just the reality of all of it. And so instead of fighting the reality, my biggest advice to you is just embrace it. Recognize that this is going to take a long amount of time. This is about building relationships. And when you need money, it's really hard to get money. And so build those relationships so that when you don't need money, when things are going good, you can take money anticipating that at some point in the future, you might need money. So that's how I would prepare for due diligence. Sorry that those are generic. But if you follow those tips, you'll be able to build a very specific plan for each individual funder that you're going to talk to.
Dan, do you mind if I add something?
Yeah, go ahead.
Yeah, so from having been on the front end of the due diligence process quite a few times, just some very basic practical tips. I found that the more thorough the pitch deck, this is a super obvious answer, but you'd be surprised how many kind of half-baked pitch decks I end up seeing. The more thorough the pitch deck, the more the investor is going to like you from the beginning. And also, the more forthcoming you are with information. Typically, investors are not going to sign an NDA. And if you ask us to sign an NDA, then it'll probably turn us off pretty quickly. We're not going to go and share your proprietary secrets with everybody. We just want to make sure that we can fund the best solutions. So if you're forthcoming with information and honest with our questions, especially ones around what are like the potential weaknesses of your company, then it'll make the process go a lot smoother and it'll make building that relationship a lot easier.
Awesome. Thanks, Libby. So here's a question. How do you start those relationships without asking for money up front? How do you catch investors' attention without having a clear request? Everyone loves flattery. So if you say, I saw you this, your background, you did X, Y, and Z, which is relevant to what I'm doing. I would love to talk to you about your experience. I want to know, what you learned about the industry. Or I saw you funded this type of company in this geography. I want to understand what you're looking for when you invest in Kenya or when you invest in Rwanda. And that will catch investors' attention far faster than saying, I want you to write me a check for $250,000. And so again, some of this goes back to the research. Think of raising money as dating. And so when you first start dating someone, you want to establish common ground. And you want to identify things that the two of you are interested in, that the two of you can talk about. So it's the exact same thing. Any other questions? And I promise I won't use any more dating analogies. All right. We have somebody that raised their hand. Do they want to come off of mute and ask the question?
Yeah, absolutely. Dan, can you hear me okay now?
Yep.
Hi, sorry, I thought just given the time, it would just be way better to just chat.
Yeah.
I have so many questions, but let me prioritize. In terms of the structure, so I'm sitting at this case now where we have a startup. We're just about to go to market on an application that deals with safety in the streets, specifically focused at women and sexual minorities. So our SDGs we're hammering hard at there are gender equality and the peace and justice elements. So we're about to launch the app and I need to structure the business legally now. The vision from the start is an international impact. I'm based in Argentina. From an investor's point of view, how do you want to see the business legally set up? So I've had advice to register in Delaware. I'm being told only have another entity here that deals with the local ownership elements. I won't go into details if that's enough for the question. I mean, what do you look for?
Yeah, so that's we're more flexible than most other people. If you're planning on raising money from US-based investors, they're far, far more comfortable with a Delaware C corporation. And so kind of anything other than a Delaware C corporation, you're going to have to explain. And that doesn't mean that it's going to kill the deal, but it's one additional thing that you'll have to explain. But if you say, I'm a Delaware C Corp, they're just going to say, that's great. All of my other companies are Delaware C Corps. I know how to think through that. Like, that's super easy. And then whether or not you have a local business really is a function of what you need from an operational standpoint.
Okay.
And so from an investor standpoint, if you're raising money from US-based investors, Delaware C Corp makes a lot of sense. Everything else should be focused on the operations of the business. And so that's really up to you and the team that's operating to decide, should we have a local company, or are we okay being registered as a foreign entity? And investors really won't care about that level of detail.
That's amazing. That was my intuition, and I've just been hammering around so many sources to get that clarity. So thank you so much. I have a ton of other questions, but I'm going to step back for now. And if there's time, I'll come back. I'll loop back at the end.
All right. Yeah. In the chat, we have a question from Nestor. Let's see. You get the money when you show you don't need it. I deeply believe we should work towards change this error in the system with new trust mechanisms. So I agree with that. As an entrepreneur, you are so busy building your own startup that I found that you will find lots of things that are very frustrating, and you just need to make up your mind and say, I'm only going to focus on the things that I can control. And that's something, building these trust mechanisms are so outside of your control that you will go crazy working on them. So while I agree that it's a total pain to have to deal with it, building your company is so hard that you kind of just need to say, I'm okay with all these other asinine things that have to do with raising money. That's the pain that you have to pay to be an entrepreneur. Is it fair? Absolutely not. But like being an entrepreneur, I talk with a lot of people and they say, that's so incredible. You've had all this success. And being totally honest with all of you, I don't know if I would wish being an entrepreneur on my worst enemy. It is so difficult. You have so many sleepless nights. So few people can relate to you. There's so much stress in your life. Like it is really, really difficult. Which is, one of the reasons why we're structured the way that we can, so that we can try to be a champion for all of you. And so just my personal recommendation is, you're already signing up for such a difficult life being an entrepreneur, that you just have to say, this is what I can control. This is what I'm going to worry about. And then I'm not even going to have an opinion on these other things. We had a couple other people raise their hands. Juan, do you want to come off mute and ask your question?
Absolutely. Hi, Dan. How are you? My name is Juan Giraldo. I'm co-founder and CEO of Waku. It's a healthy beverage company where we make herbal teas that support a healthy gut. And we have a social impact mission in Ecuador, where we source our ingredients in my home country. Thank you for the advice, really useful. Quick question. What's your advice on how is the best way to keep these potential funders updated while you continue to build the relationship? So let's say I found that venture partners are usually really, really busy, and it's not that easy to get them on the phone. What do you like in terms of how to keep you up to date with what's going on in the startup?
Yeah. So if an entrepreneur sends me a monthly email that's short, that says progress, wins, losses, and then, this is the help that I'm looking for. I need a connection to XYZ company or whatever it is. Super short, bullet point form, something that I can read in, 3 minutes or less. But sending that every single month, honestly, I might not read it the first 1, 2, or 3 months, but if you're consistent, I will absolutely read it. And what most venture partners do is they'll just forward it on to one of their associates. But that slow drip and being consistent about it every single month, these are the updates. What normally ends up happening is we get one of those and I say, holy cow, this person's made a lot of progress in the last 6 months. I really want to talk to them. And so I normally end up reaching out to those entrepreneurs and saying, love this update. When can we schedule a call? And so you should be compiling a list of all of these investors. You should make it as long as possible, and you should just send them the same update email every single month.
One just quick follow-up, Dan. Do you expect entrepreneurs to share their cash on hand information in the runway that they have, or not?
Not in an update email like that, but when we're talking, absolutely.
Thank you very much.
In the chat, we have so we have a question about valuation. So valuation really comes into play when you're dealing with equity, and really only equity. So the easiest rule of thumb is every time you raise money, regardless of how much money you're raising, you're going to give up about 20% of your company. And so what that means is whatever your next milestone is that you're trying to fund, that milestone is so important that it's worth about 20% of your company. And it doesn't matter if you're raising $100,000 or $10 million. And so Libby, if you can make a note, let's send Marcella the worksheet that we have on valuations, different ways that you can value your company. And then if you can send that out to the group, Marcella, you'll see that we'll send you 4 different ways that you can value your company, and they all have names. No one in the venture world knows what those names are. So if you say, I used this formulation to come up with my valuation, they will all say, I have no idea what you're talking about. So don't ever reference like the names of the way that you can value these companies, but know the individual processes. And what's important to know is no one just uses one. They'll use 2 or 3 to kind of triangulate some ballpark number. And so it's an art, not a science. It's all a function of negotiation. But this worksheet will give you a good idea of how to think through it. So yes, Libby left a comment in the chat. When we think through being acquired versus going public, the chances of going public we think are like 1%, and the chances of being acquired we think are like 99%. Very few companies end up going public. And so really when we talk about in equity investment in some final financial transaction, we're really assuming that it's going to be an acquisition. And then, so there's another question specific to us with philanthropy grants and R&D. We generally won't fund R&D. And so it goes back to, we want to be working with a group that already has a working product. And so that's just a function of our stage. That's unique to us. You'll find groups where their sweet spot is we want to fund super early stage ideas. And so that just goes back to asking the fund, what are your specific requirements? But at University Impact, we kind of want to be the step right past R&D. Any other questions?
Yeah, maybe if I can ask a follow-up, Dan. How do investors deal with business models around data? This is another major conflict I have. The app provides a solution in such an intimate space that I've been quite resistant to this idea of building a business model around data. But the truth is that unless we go to market free of charge, there's really not a lot of hope for scale. So the angle now is to look at, well, aggregated data. So you have a safety app tells you a lot about where and how and in what context people feel under threat, and that can be of massive use to certain organizations and institutions. How do investors look at that kind of business model, and what do they look for?
Yeah, so being totally candid, we haven't dealt with a lot of businesses in data. So some of this is from my experience, not in the impact space. So when you're looking at data, it's all about how you can monetize that data. So if you have a free product, the user is the person using the product, but your customer is somebody else. Your customer is whoever is willing to pay you for that data. And so one, you want to have a clear understanding of both. And what happens in this comes up a lot in the social impact space, is there are a lot of conflicts when you are selling data. And so you just need to think through from an impact perspective, what does that mean that our source of monetization is personal data, whether it's aggregated or not? And what happens is people are willing to pay for data that is not aggregated. They want specific, the reason that data is valuable is, well, you know, depending on the project, you should ask yourself, why is this data valuable? And what is the most valuable form of this data? And in a lot of cases, it's not aggregated data. You know, they want the raw data. They want to be able to link it to, you know, specific individuals. And so you will end up dealing with all of those, I don't want to say moral questions, ethical questions on how you manage that when your customer is different than the user. And yeah, go ahead, Pierre.
No, just thanks. I mean, you've hit the nail on the head. That's the conflict, is it that ethical space and monetizing that. Because with the social impact, you obviously want that to be wider. As soon as you put a price on it, you're jeopardizing that. So that's the great conflict we're in at the moment. I really appreciate the response. Thanks.
If you look at Red Hat, they've done an interesting job with open source data. So if you look at, like I would look at ways that people have monetized open source businesses. And so that's
a good way of putting it.
You know, if you say the data is going to be open source, are there other ways that you can then monetize your business model? And this has happened a lot with open source software. So, you know, I would look at that and see if there are other lessons to be learned in other types of business models that you could pursue.
Superb, thanks. Yeah, we've kind of, one thing I was playing with is sort of voluntary payment method, but it's very, very difficult to communicate, but we'll keep playing. I appreciate it. I don't want to hog the mic.
Yep. Juan, I saw that you raised your hand, and then we have another couple of questions in the chat.
Yeah, absolutely. Dan, could you please talk to us a little bit more on when is the right moment to ask for money, and how do you ask for money after you've been building these relationships?
So the right time to ask for money is one, when you don't need it, but when you know what you are going to need it for. And so, you know, if you build out that roadmap and you can say, this is how much this development piece is going to cost. This is how much it's going to cost to get in front of X number of users. This is the milestone that we want to achieve. This is what it's going to cost. Once you have that, you know, you should have a financial model that then says, this is how much cash you currently have. This is how much cash you're going to need. If you can't get to that milestone without external funding, that's when you should be asking for money. You have money in the bank, you have some runway, you know what you're going to use it for, you know a specific amount that you need. And then the way that you ask for it, I would just say, this is why this milestone is so important. This is what this milestone is going to cost. And so we're you know, this is how much money we have on hand. So, you know, like, you can do the back of the envelope math. We need $150,000. And, you know, if you've built a relationship, having that conversation is actually pretty easy.
Thank you.
So there's a question on C corporation or B corporation, which attracts more investors. So B Corps, most investors are comfortable with them. Very few would care if you are a B corporation. If you are a B corporation, you know, I don't think anyone says no because of it, but no one's going to say yes because of it. Investors still prefer a Delaware C Corp over anything else. I have a slightly cynical view of B corporations. It's mostly a marketing gimmick. Yes, you agree to some things in your overall governance of the company. So yeah, I don't have a super strong opinion there, and I actually don't think most investors do either. What do you consider specifically as great uses of funds for early stage enterprises with a product in the market? So whatever your next milestone is, so I would think of your business from a milestone perspective. What's the next big milestone that we need to achieve? What are the big assumptions that that we need to prove out to de-risk the business? And so there should be key assumptions tied to each of your milestones. And so, yeah, I would always try to tie your use of funds to whatever the next milestone is, and just be able to articulate why this milestone matters. So we're coming close to the hour mark. I'll put my email here in the chat. And so feel free to email me with any additional questions. Libby, are you okay if we also put your email in the chat?
Yeah, of course. And especially, excuse me, especially if you have any questions about what it's about our student initiatives or what the student investors are like.
So feel free to reach out with any questions. We'll get some of those materials over to Marcella, including this presentation, so that she can send it out to the entire group.
Perfect. Thank you so much, Dan and Libby. This was amazing. Thank you to all of the fellows with your questions. We'll share this presentation with all of you after the call, and also the recording for the ones who couldn't join us live. And I just want to thank you, Dan and Libby, again for this opportunity. It was really amazing, and I hope you all have a great rest of the day.
Yeah, absolutely. Thank you so much.
Bye-bye.
Thank you all for your time.
Thank you.